Last class, we looked at long-term solvency ratios, and we hope this would bring to a close investment ratios, but not ratio analysis. So ratio analysis continues as theoretical, and the interpretations in other conversation part of the Chapter 2 financial statements analysis. So investment ratios are metrics used to evaluate the performance and profitability of investments. So shareholders, internal and external, invest, and their main motive is returns. So the performance and profitability of the investments they have made in any company is what motivates, or they hope to get returns in turn. These ratios provide insights into how effectively the company is generating returns on its investments and how well it is utilizing its resources to create shareholder value. Exactly. So the essence of every investment is to create shareholder value or build wealth. And this is very important. So these ratios give us insights into how effectively the company is building this wealth for them. The numbers speak to the fact that either it's up or down. It tells whether your value is appreciating or is eroding. So these ratios are significant in telling investors that this is your value per time. They are crucial for investors, for analysts, and also management, as they help assess the attractiveness of the investments, compare it with peers, that's peer companies. So in the public listed company space, we have companies there, some in the same industry, some in different industries, some in different sectors. So you use these ratios to compare. So for example, Dangote Cement and Boa Cement, what's the ratio of their dividend yield, the dividend cover, the earnings per share, how much in naira. So in different pairs, these ratios help to compare the value these companies have built over time. And it also culminates in decision making of buying, holding, or selling shares. So generally, this is what investment ratios help investors do. They help you to make decisions for whether to buy, whether to hold the shares, or to sell. So if the shares have appreciated that you bought based on a particular price in a particular time, you can over time access their value if it has increased, sell them off, decide to hold them, or buy more. And that's what these investment ratios help to do. So that's just a brief introduction into investment ratios. So there are about, I think, 7 of them, if I'm very correct. Yes, so there are 7 of them, prominent ones that we'll be looking at in this conversation. Okay, so one of the main ones is earnings per share. It measures the amount of profit earned during an accounting period for each ordinary share in issue during the period. So earnings per share is telling you that after dividend have been declared from profits, how much does that profit earn you per the share you have in that company. So once profit is declared per year in every financial year and dividends are distributed to shareholders, the earnings per the share you have in that company is what this ratio speaks to each period. So the formula is clear on the screen. Profit after tax, because that's the bottom line, and after all deductions, internal, external, organic, inorganic, cash movement, non-cash expenses have been removed, and also any restrictive covenant, which has to do with preference, have been deducted from the profit after tax. You now divide that amount by the number of ordinary shares to see how much each unit a shareholder can go with. So the numerator is profit after tax minus preference dividend divided by the number of ordinary shares that has been issued out by that company. So it will be shared evenly or equally. So the more you have, the more return or earning you get from the profit declared. So those that have 1,000 shares and those that have 1 million shares cannot get the same return when profit is being declared. And that's what this ratio or the formula speak to. The metric indicates the portion of a company's profit allocated to each outstanding share of common stock or ordinary share. So the profit that is shared is divided between the outstanding shares or the shares in issue at that time or that particular period in time. It's a vital indicator because the company's profitability is widely used by investors to gauge the company's financial performance. So the more the profit after tax in value and amount, the more shares and value of the shareholders' unit of shares is built up. So where less profit is made, they have less value. Or where more profit is made, they have more value and their shares appreciate. The earnings per share provides insight into the company's earnings potential. Exactly. It helps investors assess the value relative to its share price and make informed investment decisions. So where much profit are not made, they are in a particular period, their shares remain static. And where much profit is made and dividends declared, their shares appreciate. That's what it means. And this ratio gives an insight into how it appreciates. So it's the same formula, just that it's also called net income. So where you see net income, profit after tax, net income is the bottom line after all associated expenses have been deducted, and you must deduct preference dividend. Very important, because that's restrictive. Before ordinary shares go with the remaining profit, they have to give preference stockholders their money, and you divide it by the number of ordinary shares and distribute to shareholders. So the net income is the profit after tax and other expenses. Preference dividend are paid to preference holders, subtracted to reflect the income available to common shareholders. And the number, yes, exactly. And number of ordinary shares account for any changes in the number of shares during the reporting period. So where there are there's a number of changes, maybe which they looked at additions, people bought more shares in the period under review, they also come under these ordinary shares, and they help to, or they partake in the profit sharing, and those that also dropped off or sold off their shares are removed, and the unit of the outstanding shares that are in issue for that period are used to calculate the earnings per share. So before we go to what it means, let's quickly look at how to calculate it very practically. It's very simple and easy to interpret. I love this set of ratios. So let me share the document and let's look quickly into the calculations very graphically. Okay, so I've moved to the Dan Kabir document, and we'll be looking at the calculation. So from our SCI, we have our profit after tax, which is for 2020, we have it as 77 million. So our profit after tax for 2020 is 77 million. So let me pick that. Let me put up the formula on the screen so that you can help me calculate 2021 and 2022 based on that. So I think what I'll do is I'll take everything so that we can validate it. And as we are calculating, it's like a check. You are checking me, I'm checking you. So you're using a calculator, I'm using Excel. So I don't make mistakes with the formula, and we're on the same page. So I'll take for the 3 years, but I'll just calculate for 2020.
I'm looking for preference dividends. I've not seen it though. Okay, I've seen it. Preference dividend. No. I've seen dividend. I'm not saying preference dividend.
Okay, so preference dividend should be under your current liabilities. Sometimes it comes under notes to the account. But here, if you look at your current liability, you'll see preference dividend after.
Oh, yes, I've seen it. I've seen it.
Exactly. So let me pick my preference dividend also. So at times it shows up under notes to the account, stating that it has been declared. And if it shows up under current liabilities, it's yet to be paid. That's what it means. It's a current liability that has not been settled. Okay. So I have, so let me just call it net income after I've deducted the preferred dividends. Net income, even though it's the same thing with profit after tax. So I'll just less profit after tax minus. Yeah, so I've deducted it. I have, there's so much preferred dividend, 47 million is off. And they even have less than the preference dividend as their profit. Now, wow, ordinary shareholders are really going through a lot.
I'm telling you, I've deducted my 32,725. Can you imagine?
I'm telling you.
37,634. Kai.
I'm telling you, the money
Now,
is
the number
20.
of shares is not, maybe it's not to the account, Abby.
Yeah, so let's look at the notes to the account. How much is the nominal value of the shares? So we have to look at the nominal value to determine.
₦1 each.
Oh, okay. Okay, good. So we have for the 3 years, 210 million naira worth of shares. So 210 times 1 naira is the same 210.
210. So 210 for both.
Yes, exactly.
110,000.
So, yes, 210 million.
10 million.
Yes, exactly. So we have 210 million, fantastic, as ordinary shares. So let me calculate the earnings per share for 2020. So you do 2021 and 2022. And this gives us net income divided by ordinary shares. And we have 14 kobo. 14 kobo only. 14 kobo with the volume of shares somebody have will amount to millions of naira. Okay, so I have 14 kobo for 2021. What do you have for 2020? I have for 2020. What do you have for 2021 and 2022?
16 kobo and 18 kobo.
Okay, it grew 16 kobo and 18 kobo. Wow, their shares grew. Not bad. It's not bad. All right, so let's validate this now by, let me just drag here. Okay, I've not gotten the net income, so let me drag my net income. Yes, let me get the net income. Exactly. We're on the same page. Very correct. So I have 16, I have 0.8. So 14 kobo, 16 kobo. So they grew by 2 kobo every year. So imagine somebody having 1 million shares, because the total share is 210 million. So if you have 1 million shares now, your share grew by 14 kobo. So at 1 naira each, you have 1,114,000. 114,000.
160,000.
16 kobo will give what?
160,000.
Yes, 160,000 exactly. So imagine you have 1 million now, and in a year you already have 160,000 added value. That's a good one.
Okay.
That's a good one. Yes, in a financial year. So 18,000 will give you 180,000 exactly.
Okay.
So the more the
1 million
shares,
naira and 160,000. Okay.
Yeah. So that's what you have added value. Okay, so let's look at what it means quickly. Earnings per share represents the amount of profit attributable to each shares of common stock, reflecting the company's profitability on a per share basis. So if you have 1 share in that company, you automatically have improved value in 2020 by 14 kobo. So your share will now be valued at 1 naira 14 kobo. So the profitability of the company is on a per share basis. That's what it means, and is a crucial measure for evaluating the company's financial health and performance over a specific period. And their performance with this measurement, if they don't have a positive bottom line, then there's a problem. They can't even measure this ratio. So where there's negativity in the profit after tax or the bottom line, the companies cannot even calculate this ratio, talk more of distributing profit. That's why the earnings per share is a crucial measure in evaluating the company's performance. It's very important. So what's the implication? A higher earnings per share indicates greater profitability. and can attract investors. Exactly. So in the case of Dan Kabir, it will attract investors because on the 3-year basis, the earnings per share keeps growing. And that's one thing in investments. People want to see growth and they're rushing. So investors, when they look at the stock market and look at the Nigerian Stock Exchange or the New York Stock Exchange, where there are the shares are, and they see growth, they tend to buy the shares. One of the reasons why I bought First Bank shares sometimes back is the growth over a 5-year period. And they give you a 5-year financial summary with these ratios, and you just see that their shares keep growing. So like MTN now, perpetually and consistently they've been growing. So when you look at this earnings per share, 2 kobo, it moves to 4 kobo, 9 kobo, 16 kobo, you'll be propelled to, let me buy some units. And that's what attracts investors, and a higher earnings per share as they grow over time leads to a higher stock price. While a lower one conversely raises concerns about the company's financial stability and could negatively impact stock price. So a lower one used to propel people to want to sell the shares so that they can at least recoup their capital or whatever it is they invested before it erodes in value. So a negative one could really spell doom and send negative signals to investors about stability and impact of their stock price. So earnings per share is often used in conjunction with other ratios like PE ratio, dividend per share, which we'll be looking at subsequently to assess the relative valuation of the company's stock. So the earnings per share does not work in silo. It's good to measure them with other kinds of ratio to see their market value. So price to the earnings talk about the market value of the shares in relation to the company's value of the shares. So this measurement pari passu each metric helps you to make better decision. You cannot just decide on investment based on just the earnings per share. Using other metrics like PE ratio is good to assess the relative valuation of the company's stock. So what are the causes and effects of a high EPS? Increased revenue, cost management, improved operational efficiency, or a reduction in the preference dividend. Like both of us shouted when we saw, how can preference dividend go with 47.25 million? That's high. So when there's a reduction in preference dividend, the bottom line will be higher. And you see all these covenants can be very restrictive. They provide a little amount for shareholders. And that is why some always refuse preference shares, because the covenants can be stringent and harsh on shareholders. But it also has the advantage to go for preference shares because the funds are provided in large amounts and they help you expand and treat other areas of the company finances to help move the company forward. So they have the advantages and disadvantages, but where you have a high bottom line, it reflects a high EPS at the same time. And the effects is enhanced investor confidence where you have high earnings per share, potential increase in the share price. So the share price in the market price per share is different from the company price per share because their values are different. And where you have high EPS, it can attract new investors. It culminates in people come after those shares. While a low one can be caused by decreased sales, rising expenses, increased competition, and adverse market or economic conditions. And the effects is clear. Decreased investor confidence, potential decline in the share price in the stock exchange, difficulties in raising capital, people begin to sell their shares. It culminates in very bad responses from shareholders and potential investors. So in conclusion, EPS is a fundamental measure of a company's profitability and is critical for evaluating its financial position. Exactly. So financial performance. The performance of the company is critical in this ratio, and the bottom line is the key metric. So by analyzing EPS, investors can assess a company's ability to generate profit relative to its share base, helping them make informed investment decisions. Exactly. And chartered accountants and also investors, others need to monitor EPS trend, essentially for understanding the company's growth strategy. So you can see that over a time period, you look at how many Kobo has or how many Naira has improved the value of the company's share ordinary shares. And this trajectory can impact the overall financial health of the company. It's an interesting ratio. I love it, and it's very practical because the EPS and the DPS are two main ratios that influence investor decisions. Okay, so that will be the end of EPS. Do you have any questions?
Not really, just a practical thing. These preference shares, do they advertise them for sale?
Well, they really don't, like ordinary shares. So what they do is at their AGMs, they call for stuff like that. So it may not be on the dailies, but during AGMs, they do that, especially where they want to raise special finance. So they do that. So there may be shareholders that are ordinary that may provide those preference shares, and also practically there may be external people that are in that meeting that also opt for it, since they know the benefits and the risks, the lower risk of their returns that come with it. So it's internally mostly announced during the annual general meeting. It's not really posted on dailies or news for people to buy. Yeah. So it's like you want to go for preference shares. You like the returns and the lesser risk associated.
But the thing about the matter is that it's still going to be profit after tax you use. You know, it's not. And if there's no profit, there's no dividends.
Exactly. Even for preference, there won't be dividend. That's true.
So,
but you know, the restricted thing about that is for that period, if there's no profit, the next period, if there's profit, you have to pay the previous one. So for 2020, if you didn't have profit, yes. So it's a restricted government. You accumulate it. If you don't pay for 2020, no problem. In 2021, you pay 2020 and 2021 together. Don't pay profit, but when you make profit, it will accumulated and paid to them. That's the restrictive thing about it.
Okay.
Yeah.
But profit is what value? You know.
So it's an agreement now with the management and shareholders of the company that this is the value we pay you for providing us this special finance. So once they agree on that, if you like, make loss for the next 5 years. When you are ready to make profit, you pay them. And if you don't make profit at all, they will have to sell your assets and pay them off. That's how bad it is. So preference can be very, very restrictive, and a lot of wise companies avoid it. They avoid those shares, except where it's very important, they need to engage. All right, thanks for that value-adding question. So let's go to the next one. If you don't have any questions.
Earnings.
Yes, price-earnings ratio. Price-earnings ratio. So it's good to use this ratio when you are calculating earnings per share to compare their results. It's very nice. This ratio compares the earnings per share with the market price per share. So you see, the earnings per share is what the company has declared, but now the price earnings ratio is comparing your earnings with what the market price of the ordinary shares is saying. So your price, or what you declared per share, may be 1 naira. The ordinary shares may be valued at 1 naira, and including the dividend for that year, it may be 1 naira 14 kobo. Let's say in Dan Kabir's case. So for 2020, the share has appreciated to 1 naira 14 kobo. But in the market, the price is different on the stock exchange. The value is always higher, especially when the shares are doing well in the market over time. So the market price is good, and it helps investors to calculate the number of years it will take to recover the market price for the share if earnings remain constant in future years. So how the company is doing as a unit of each year influences how the market sees the company and the value. So I can call market price by share the goodwill of the company. So in consolidation, they call goodwill. Goodwill is not seen, but it is the amount the company is valued as a brand to people outside. So they quantify it in monetary terms and say, okay, this is the monetary value of your shares and how people see your company. So the formula is your market price per ordinary shares divided by the earnings per share. So we'll now see how the company has appreciated in its earnings per share based on the market. Of course, it's the market that determines the value of your shares, not the company. The company only gives the profit and adds to the value, but it's the market that determines the value of your shares. It's a widely used financial metric that compares the company's current share price to its earnings per share on a year-to-year basis. This key indicator for investors help to assess the market value of the company's stock relative to how much it has earned per year. The PE ratio helps investors determine whether a stock is overvalued exactly or undervalued or fairly priced based on its earnings potential. So please take note of this. So the overvaluation, undervaluation is now depending on whether the stock is doing well or not. So when in the market, for example, your share is about 10 naira and in the company is just 1 naira, they'll be like, this thing is overvalued. Why are they overpricing this thing? That's because the value is appreciating astronomically. But when it's undervalued, the shares in the company or the earnings per share is reading 2 naira and in the market is 3 naira. I'll be like, why is it undervalued like this? Is it that they are scared? So if it's fairly priced, maybe it's twice the value in the company, they'll be like, okay, it's fairly priced. So the earnings potential of that shares over time determines whether it's overvalued or undervalued. Very important. So the formula is also shown on the screen. Again, the market price per share over the earnings per share. Now we have the market price per share as the current trading price on the stock exchange of one of the unit of the shares of the company stock. So the current trading price. So just like the Forex trades on a particular time, this is how much dollar is today, this is how much dollar is tomorrow, based on the unit you have. So if you bought your dollar at 200 naira and at a particular time it had appreciated to 1.6, you have profit. So that's the example I could use for earnings per share and market price per share. So over time, you bought maybe your shares at 1 naira 50 kobo, but it has appreciated over time to 5 naira, 10 naira in the market. So when you want to sell it, you are not selling it 1 naira 40 kobo, you are selling it at 5 naira, the market price per share. So it's the current trading price of the company's share of the company's stock. And the earnings per share is the company's profit attributable to each outstanding shares. So before we see the meaning, it's a very simple ratio. In fact, I like the calculation. You don't need to take any variables from the only thing you need to take is your market price per share. So we already have our earnings per share as 14 kobo, 16 kobo, and 18 kobo. So let's go to Dan Kabir, the question now, and look at the note. How much is the shares valued in the market? Good. So if you look at note 4, the proposed share price on the Nigerian stock exchange is 5 naira per share. Wow. So at 1 naira each year for 2020, the shares is now 1 naira 14 kobo. As at that time, the proposed price of Dan Kabir's share is 5 naira in the market. Almost 3 times. No, almost 5 times, right? Hello, Julia, are you there?
Yeah.
I said, how many times is the share price at 5 naira?
After a while, I couldn't hear you.
Oh, a network. So sorry. Where did you lost me?
Wow, talking about price per share, earning per share. The other screen.
Okay. So I was talking about the market price per share, and I was saying that the price in the market is different from the price in the company or the price of the holdings of the shares. Yes, exactly.
Is it in the footnotes, or what do you call it? Yeah.
Yes, in the notes to the account. Yeah, so you can see the market price per share in the notes to the account. Yes. So you see, as at 2020, 2021, 2023, earnings per share is just 14 kobo. So if you add the 1 naira nominal value, it's about 1 naira 14 kobo, but it's almost 5 times the price of the shares in the market, showing that the company has appreciated, the shares have appreciated in value over the years. Yes, exactly. So with our 5 naira now, let's calculate the price to earnings ratio, which is our price to
Market price.
earnings ratio. Yes, so it's market price per share divided by the earnings per share. So we have that as, yeah. So we want to see how much the price is worth and the price of the market to the earnings of the company, price in the market to the earnings in the company. So for our earnings per share, we have it as 14 kobo, 16 kobo, and 18 kobo. So we just take that, do copy and paste, and we'll do our calculation.
It's 5 divided by 0.16. 31.25.
Okay, let me do for 2020 first, then we'll do for 2020. Wow, 35.25. Wow, that's incredible. Okay, so for 2021,
31.25.
for 2021, 31.25.
Is it not 5 divided by 0.16?
Yes.
31.25.
Okay, maybe this is approximating something.
That approximate is very high.
The approximation is high. 5. Let me try it with my calculator. 5 divided by 0.16. Yes, I have 31.25.
Yes.
So let me do it direct instead of dragging the formula and see. 32.10. Wow. What do you have for 2022?
27.78.
Okay, maybe that's why they approximated it to 27.90. Okay. So why is it giving us can you hear me?
Yes.
Oh, okay. So I'm wondering why the calculation is a bit high by some kobo.
Maybe it's approximation, as you said, and it's approximation. Depends on how you programmed it, Excel. Is it 0.0 or 0.00?
Yeah, it's showing it's 0.00 is showing, so 32.09 is different from 31.25. So it's even supposed to be 31 kobo. If it's even approximated, it's supposed to be 3100 like this. Okay, well, since the dichotomy or the difference is not much, let's take it as 31, yes, 31.25. 31.25. And let's see if it's how would I put it now? How would I put it now? Okay, so this one is 27 point. This one, the difference is not much for 2020. The difference is not much, 27.90. You gave a figure. What did you have for 2022?
27.78.
Okay, so 78. Okay. All right. So what it means is that for the earnings of the company, now the price to earnings is about 35 times. That is what it means. So if we approximate this, this is 35 times. This is 32 times, let's say. This is 28 times. So it means that investors are willing to pay 35 times, 32 times, 28 times the company's earnings per share for one share of stock. That is what it means, which is high. Because looking at the market price per share, 35 times, 32 times, and 28 times. Wow, it's hard. This is how many times the company the investors are willing to pay, potential investors, based on the market price of these shares of Amkabir. That is what it means, which is a good one. Let's look at the meaning. So the price earnings ratio shows how much investors are willing to pay for each naira of earnings. That's why I said how many times. So for this 2020, 35 times. Because if you look at 5 naira to 14 kobo, it's quite high. 35 times, and this is 32 times, and this is 28 times. It's quite high. And the shares are doing very well on the market, on this floor of the stock exchange. So the PE ratio shows how much they are willing to pay for each naira of the earnings. And a high PE ratio suggests the market expects strong future growth. Exactly. So the market looks at the trajectory and said, no, the company is doing well and they expect good future growth on these shares. While a lower PE ratio may indicate the stock is undervalued or that the company has slower growth prospect. So undervaluation and slow growth could be the cause of a low ratio, while overvaluation and strong future prospects is the reason for a higher PE ratio. The ratio is often used to compare companies within the same industry. Exactly. So like I said, Boa Cement, Dangote Cement, you can only use, it's good to compare within the same industry, not Dangote Cement and Dangote Sugar. They are two different products. So this ratio is actually used for companies in the same industry. So what's the implication? A high PE ratio indicates investors are expecting high future earnings growth and are willing to pay a premium for the stock. Exactly. So high yielding stock, a lot of investors can pay a premium, especially when they see prospects in the company or in that industry. However, it can also signal that the stock is overvalued. Yes. So future growth prospect and overvaluation could be the cause of a high PE ratio, while a lower PE ratio is undervaluation and also slow growth prospects or potential buying opportunity, and also concerns about the company's profitability and its future growth prospect could be the reasons for a low PE ratio. This is very important. So causes of a high PE ratio are investor confidence, strong growth potential, optimistic market sentiment, lower current earnings compared to future expectations. These are the causes of a high PE ratio. Why the effects include stock may be more expensive. Yes. You have to pay 35 times for the ratio in a particular year because it has appreciated. Growth-focused investors, but also increasing the risk of overvaluation. These are the effects. While a lower one is caused by slow growth, declining earnings, undervaluation, market pessimism, or the stock being undervalued. The effect we've spoken about it could detract investors looking for bargain. To attract investors looking for bargaining and also make some current shareholders sell off their shares. It may indicate also concern about the company's future earnings potential. So in concluding, PE ratio is an essential tool for evaluating a company's stock price relative to its earnings per share. It helps investors make informed decisions about their shares, and the issue of buying, holding, or selling it based on the valuation, this ratio helps to really make or propel that decision. And a high one indicates growth potential, but could also signal overvaluation, while a low one, startled growth, future challenges, and undervaluation could be the reason for a low one. So investors should, alongside the PE ratio, use the earnings per share and others to make comprehensive assessment that will culminate in their decision making. This is very important. Okay, so that will be the end of earnings per share. Do we have any question? Do you have any question on this?